Welcome to the Customer Wins podcast, where business leaders discuss their secrets and techniques for helping their customers succeed and in turn grow their business.
Hi, I'm Rich Walker, the host of the Customer Wins, where I talk to business leaders about how they help their customers win and how their focus on customer experience leads to growth. Some of our past guests have included Tom Riemann of Practice Intel, Justin Baumgren of William Joseph Capital Management, and Cormac Murphy of Cash Tech Advisor Solutions. Today, I get to speak with Mark Friedenthal, founder and CEO of Tolerisk. And today's episode is brought to you by Quick, the leader in enterprise forms processing. When your business relies upon processing forms, don't waste your team's valuable time manually reviewing the forms. Instead, get Quick. Using our Form Extract API, simply submit your completed forms and get back clean, context-rich data that is 99.9% accurate. Visit quickforms.com to get started. Now, before I introduce today's guest, I want to give a big thank you to Param Nasseri, the president of InvestorCom, also a prior guest on this show. Go check out InvestorCom's website at investorcom.com and see how their regulatory compliance solutions can help your firm turn compliance into a strategic advantage. All right, Mark Friedenthal is the founder and CEO of Tolerisk, which provides investment advisors with fiduciary caliber risk tolerance assessment technology to accelerate practice growth and reduce compliance risk. Mark also founded Friedenthal Financial, an RIA firm based in Marlton, New Jersey. Previously, Mark was responsible for capital markets, asset liability management, and risk management departments at Citigroup, Cendant, and GE Capital. Early in his career, he served as an analyst with the Federal Reserve. Man, you got the right background for this, Mark. Mark has been published in numerous publications, including Reuters, Financial Advisor, Financial Planning, Investment News, and many others. Mark, welcome to the Customer Wins.
Well, thanks. Thanks, Rich. I appreciate you having me.
I'm excited to talk to you today. For those who haven't heard this podcast before, I talk with business leaders about what they're doing to help their customers win, how they built and deliver a great customer experience, and the challenges to growing their own company. Mark, I want to understand your business a little bit better. How does your company help people?
So our customers are financial advisors, investment advisors. Their customers, of course, are investors, their clients. And so we help our customers help their customers understand complicated topics around risk more easily so they can make better decisions and they can have the confidence to stick with those decisions.
So I want to talk about the product, but I want to think about something else. Your customers are your customers. And that's a common thing, I think, in business to business. How do you think through whose success you're trying to drive for first? Like, how do you help each of them become successful when you design a product?
So we focus on advisors, that's our customer, but we recognize that for them to be successful, they have to deliver a successful service. So we can't lose sight of how they help their customers. And I think maintaining that sort of second level view into the process is important. And having been an advisor has helped me in that regard. And frankly, we co-locate these two different businesses. So just down the hall, I have access to advisors who are operating presently with clients and of course, deep users of Tolerisk. So I get to hear their experiences with their clients on a pretty regular basis, which helps me stay on top of technology trends and needs. And that's how we continue to stay on top of this industry.
So tell me your story, why you did this. I mean, did you build this for yourself and then say, hey, other people need it? Or did you leave financial planning to do this?
Yeah, I mean, it was definitely a necessity was the mother of invention kind of story. So I left Wall Street, it's about 15 years ago already, and started the RIA. I used lots of high-end vended solutions, but I couldn't find a good tool or a good process to help clients choose the right risk level and have something that would evolve with them intelligently as their circumstances evolved. And so I ended up drawing on my previous background, which was a lot of applied math. You know, I spent a good bit of my earlier career building math models used in risk management functions, trading, and portfolio management type functions. And so I kind of leaned on that to solve a problem that I had. In fact, you mentioned Federal Reserve. That's really way back in my career. But I think as a former regulator, my first thought was to look to the regulator in my new environment, which would have been the SEC, and see what were we supposed to be doing around client risk tolerance. And the SEC described risk tolerance as someone's willingness to accept risk and also their financial ability to take risk. And those sort of two terms, willingness and ability, kind of resonated with me. And I thought about the things that I saw out there, and they were mainly these very basic quizzes. They were overly personality focused. They neglected to incorporate real financial data into the process. So it was very detached from the financial planning process. And I just thought, even in 2009, as a fiduciary, how were we not including the client's financial data, which was pretty readily available, into advice as important as a risk directive? And advisors weren't doing it. And so I decided I was going to remedy that problem just for my own advisors. And so I built this big spreadsheet model, which adapted traditional bond math to household cash flows. And that enabled me to measure objectively what somebody's financial ability to take risk was. And I could also measure how it would evolve over time as their circumstances changed. And I was able to calibrate that to a standard stocks to bonds benchmark risk level. And that made it easy to communicate with the client. And then I kind of leaned on my wife, who happens to be a behavioral psychologist with her doctorate degree. And she helped us conduct a psychometric study, an academic study that would allow us to measure an element of someone's personality compared to a population. And so in this case, it was how risk-seeking to risk-averse somebody was compared to a large population. And we could use this to gauge what the cap on their willingness to accept risk would be. And so now we had the advent of the first two-dimensional construct for risk assessment that I felt really embodied the highest fiduciary standards that as I read them on the SEC's website. And so it was just this big spreadsheet model. And then after a few years of listening to clients rave about it and say they've never seen anything like it and it's super helpful, eventually the light bulb went off for me, even as thick as I might be, that there perhaps was a need for this. And in the beginning, I kind of meandered down this path, but ultimately ended up focusing really on this as we found lots of accolades and lots of need and demand and lots of wonderful partners along the way. And so the rest is history, as they say.
You know, it's funny. I wonder if Excel and Lotus 1-2-3 understood how many businesses and products would be formed on their backbone. I mean, look, even our forms was built in Excel. The first version was an Excel spreadsheet with images of forms, with fields overlaid, tied to a database to pre-fill forms. So anyway, that's just an aside. So you said there's two things: the willingness to accept a risk, and what was the other one? The ability?
Ability, yeah, financial ability. Some advisors refer to it as financial capacity to take risk, but we've stuck with the SEC's nomenclature. So you'll notice our advisors and on our site, they use the terms willingness and ability. There, I guess I'm not moving around enough from my motion sensor. Of course.
So you guys have to check out the video because he's in a dance club.
Yeah, exactly. Nothing beats live TV, you know?
No, of course not. Okay. So I'm kind of curious, when you put these two things together with your product, your service, or even your spreadsheet when you're beginning, how do you then confront the client who has a low willingness to accept risk, but a high capacity to take on risk and potentially should take on the risk?
Well, that's a slippery slope. You know, I was with you until you said should take on the risk. The challenge is, if somebody truly isn't willing to accept more risk, then the advisor potentially places them in an untenable circumstance. There are people who aren't going to be willing to live with the roller coaster.
Sure.
And so the fiduciary advisor really doesn't want to recommend someone take more risk than they believe they're willing to accept, even if they can demonstrate they have a greater financial ability to do so. So it is a little bit of a slippery slope. Now, that said, The conversation that the advisor is having with the client's really paramount. And so our framework is very flexible and really caters to that. So if the conversation yields that the client is in fact willing to accept more risk, the advisor can override the client's willingness score. They do have to document it for their own compliance purposes. And sometimes an override could be in contending with two spouses who are on different pages.
Right. This is kind of the thing I was thinking
Yeah.
about. Like you have one that's high risk, one that's no risk, but
Yeah, so
their goals kind of demand they have a higher return than what they're getting.
Let's separate that for a minute. That's actually a really hot topic. So let's separate the concept of whether their goals require a higher return. Let's put that aside for the moment. When you're dealing with two individuals, let's say spouses or partners, it may be that they're on different pages when it comes to risk. And if they commingle their finances, then they do share one ability to take risk. Now, sometimes advisors will have some differentiation to the extent that assets may be titled, some in one spouse's name, some in another. So it might be they both have a 401k or an IRA or something like this. And so they may be able to achieve some of that with some differentiation. It may be that the overall cap on risk is chosen to be somewhere in the middle. It may be that one spouse is the primary decision maker. And so maybe there's more deference paid to that spouse's willingness to live with market fluctuations and things like that. There's also other communication. Sometimes the client has had substantial experience. Maybe spouse A profiles at a 70, meaning in Tolerisk, that's a 70-30 stocks to bonds benchmark. So it's very easy to make sure everybody's on the same page with what the outputs mean. And maybe spouse B is a 60. But through communication and dialogue, they say, Mr. or Mrs. Advisor, we've had an 80-20 for many years. You've worked with us and we're comfortable going up to an 80. And so the advisor can override and lift that cap, and the rest of the math will flow through and the rest of the visualizations will flow through as well. And it would work the other way too. The client says, Mr. or Mrs. Advisor, we've never had more than 50% in the stock market and we're not comfortable with that. The advisor needs a mechanism to pay deference to that. Now, most of the time, you're not going to see huge deviations because the profile of their personality is quite realistic. So most of the time, the advisors say the client looks at the results from that psychometric profile and says, yeah, that looks and feels about right. So your example of them having two spouses on different pages, that can usually be resolved through advisor-client dialogue. Now, I want to touch on your other question.
Before you go there.
Go ahead.
Before we go there. So your product is helping the client understand their profile because there's a metric behind it. There's math and science behind it. And then that's also giving the advisor a tool set to work with that client. And am I understanding it correctly?
Yeah, it's really designed to take what for many are complex topics and make them more understandable and make them easier to explain for the advisor. The standard in the industry with other tools is that they each use their own proprietary scale. We just found that we didn't need to invent that most advisors are used to talking to clients about a stocks to bonds benchmark. And even if they don't use exactly that kind of approach, that's what they're used to conveying when it comes to some comparison of risk. You're an 80-20 or a 70-30 or a 50-50 or something like this. And so it was easier for advisors to talk to clients about risk using that same framework. So for us, a 100 is the risk level of the total global stock market. I'll tell you one of the examples that our folks often give is to score the Vanguard Total Global Stock Index Fund. And we don't have any formal relationship with Vanguard, and I can't guarantee what will be in their fund in the future, but it scores a 100 in Tolerisk. We don't calibrate it to Vanguard, but we're using that same broadest of broad benchmark indices. And so it makes sense that it scores a 100. And
Vanguard's typically index funds. So
right.
Yeah, that would make sense.
And if you put a Tesla stock in, it scores, I think last I looked, 340 something. right? It's got almost 3.5 times the volatility, the long-term volatility of that total stock market. So we're not constraining the scale either. So while we don't score a person over 100, a portfolio can clearly have more risk than the total stock market.
That's
For
good.
fun, I put in Bitcoin. Do you want to take a guess as to what Bitcoin scored in Tolerisk?
Okay, I'm going to give you my wild guess. I'm going to
Go
say
ahead.
something like 5,000.
Not quite, not quite. I think when I looked at it last, it was a 716. So it has more than 7 times the volatility of the total stock market. Now, when we find our peers, when you put a Bitcoin, a Tesla, an emerging market stock, a small cap stock, our biggest competitor scores them all at a 99 because that's the top end of their scale.
Mm,
And that's okay, but we find advisors look at positions like that and say, no, they have very different risk levels. We
yeah,
understand why Bitcoin scores 700 if it's got 7 times the volatility of the stock market, and it makes it more intuitive to explain what these numbers mean to a real person who may not have this kind of training.
yeah,
These are complicated things. So when we think about a risk assessment, there are really 4 risks that are really identified and measured and communicated to the client. One is, what is the client willing to accept in terms of a stocks to bonds benchmark level of risk or volatility? The other is, what are they financially able to take, which may change, by the way, as they migrate towards and through their financial chronology. Imagine you have a young client who's saving up for their first house. Well, if all their money is being used towards that house in a year, well, then they have very low ability to take risk.
right,
Now, they may be in great financial shape because they may still be saving money and they're going to work a long time, and they may be willing to accept lots of risk. But right now, their ability to take risk would be low. And I know most people would think, well, you're young, you should have a lot of risk, right? Take an older client. Maybe you have somebody deep in retirement. Now, if you were to look at your average retiree, would they have a reduced ability to take risk? Sure. Law of large numbers. That's fair. But there's a lot of variance from person to person. And I've seen examples where you have somebody who's deep into retirement, who's done buying real estate, they're done putting kids through college. As it happens, they have a nice pension, lucky for them. They have Social Security, and they may live on that. So their assets, their principal, may actually chronologically be expected to be used by children or grandchildren or the favorite charity or something like that. So they have the time horizon of that utilization. And so that person would score with a very high ability to take risk. For them, it's all about their willingness to accept risk. So it's
right,
whichever is really the constraint.
yeah,
I want to get back to something you had asked earlier. You said, well, what if somebody, in a sense, needs to take more risk because they need a higher return? I think that was your implication.
sure,
This is an area that I think challenges a lot of advisors, and it causes some confusion. If you look at what the CFA Society publishes on this, and by the way, not surprisingly, they get it right. They talk about someone's need to take risk in the context that if they may be willing to accept a given level of risk. Let's say they're willing to accept a 70-30 risk level, and let's just say they're able to take an 80-20 risk level. But they could achieve their financial goals of not running out of money with a 40-60 portfolio, right? That means their need to take risk is only 40-60. Well, what happens if you look at it the other way? I think where advisors sometimes step on that slippery slope is they run a financial plan, and let's say it doesn't look so good. There's a higher than acceptable failure rate. And so the advisor thinks, oh, what would solve this? Well, higher returns would make this look better. Now, we can't just assume higher returns. So what would need to happen to reasonably substantiate an assumption of higher returns? They need to take more risk to be able to substantiate higher returns. Ergo, they need to take a higher level of risk. Now, the problem is that if that level of risk is above what somebody's willing to accept, they may not live with it. They may choose it now, but when the roller coaster hits, they may more likely abandon it. And that will cause more long-term damage to a financial plan than if they had chosen the lower risk level. And by the way, ability to take risks, same thing. If you're buying a property or you're putting your kid through college, that's independent of what the stock market does in the short run. And so the presumption that most have is that you're going to pull that money out. That's what's driving, in that example, down your ability to take risks. So just because the advisor's financial planning system says, hey, you need more returns, we better put you in more risk, that can really challenge that construct and create a failure that may not be able to be overcome. So it is a challenge. So I appreciate the question, because it's a bit of a hot topic.
Well, no, it is, and it's one that I think your product can help serve to the surface, because you do have situations where somebody is able to take way more risks than they're willing to take. Maybe they have a high cash position that's doing nothing for them, and they just feel like cash is king to them. They have to have it. But if you can help them see, well, you've got a 5 and 10 year time horizon for this cash. Why is it sitting here getting 0%? And I'm not suggesting, by the way, that, to make your portfolio work, you got to earn 20% a year. No, that doesn't make sense to me.
let me just make sure that I'm clear too. There are solutions for the problem that we just identified, right?
Yeah, there are.
The right solution, if somebody's probability of outliving their money, and that's how we define it in Tolerisk, if their probability of outliving their money is too great. By the way, that's a whole other topic. What is the right probability of running out of money? But if it's too great by the advisor and client comfort level, then the right response is that the advisor is going to help coach the client to perhaps work longer, if that's possible or practical. It could be to save more and spend less between now and retirement.
Right.
It could be to downsize or monetize something else in the future, both bringing in assets as well as potentially reducing ongoing expenses, or some combination of these things. And so Tolerisk, actually, most advisors utilize one of the features in Tolerisk, which allows them to choose when a warning appears on a screen to suggest these things. And advisors have shared that it's a way to reframe their dialogue from being the naysayer, right? Imagine the advisor says, ooh, you're not in good shape. You are spending way too much money, right? I'm exaggerating a little bit for effect. But it changes the tone from that to, here's why Tolerisk is telling us that you have a 29% chance of outliving your money. And here's what we're going to do to remediate that, to help you solve it. Now the advisor is the advocate, the coach. Talk about helping their clients win. It's helping their clients win by making better decisions, also having more confidence in the decisions that the client makes, which is good for them to avoid behavioral mistakes. Also, it's great for the advisor, which is our customer. So how do we help our customer win? Well, the reason that's great for our customer is because that confident client exhibits the highest levels of retention. And they're the ones that make referrals. Most advisors tell us that 80 to 90% of their referrals come from 10 to 15% of their clients. And while I would love to sit here and tell you that use Tolerisk and 98% of your clients will make referrals, that does not appear to be realistic. But what we hear from advisors is they can move the needle. And so instead of getting 10 or 15% of their clients making active referrals, they can move that to a 25 to 30% kind of number. And even though that's still a minority, what advisors tell us is that can make a pronounced difference in the pace at which their practice grows. They also often use this with prospects. So the other area where they can accelerate practice growth is driving up the conversion rate. How do you get more prospects to become clients? You get more of them to see your level of diligence, that you're customizing your risk management process for them, that you're going to be with them through these events. That's how you drive confidence for their customer that their customer is going to win. And that helps our customers win.
One of the things I love about what you're saying and what you're doing for your customer is, when I was an advisor, now it's been over 20 years since I've been as an advisor, but when I was an advisor, I felt like a lot of my job was helping my customers make better decisions in their life. And if, I found it always funny when I would meet somebody, prospective customer, and say, Rich, I will call you when I have the money. Like, no, don't wait till then, because you won't have the right decision-making pattern then. You'll get this inheritance, you'll get this big windfall, whatever it is, and you'll spend it because you won't know you'll have alternatives. So I love that that you're creating conversation with your product so advisors can help their customers better. I love all this, Mark. Go ahead. I have a curiosity question though, but you want to react. Go ahead.
Well, no, I was thinking back to something else you had said. There are some more extreme conversations that advisors have shared with us. The young client who gets spooked. There's been a lot of reasons to get spooked in the last few years too. So we understand that. So sometimes advisors have said they'll dig deeper into the roster of analytics in Tolerisk. And we provide them with a lot of different visualizations and a lot of different content, and it's all optional. Our belief is that people learn in different ways. Mm-hmm. And, not only do advisors learn in different ways, but what they experience, right? They have to often be educators, as you, I'm sure, remember. So their clients learn in different ways. So we have to give them a wide range of arrows in the quiver so that they can reach people in different ways. And so some of the reports may be less popular, but the advisors will still utilize them in certain circumstances when they have to break them out. And so something you had said kind of reminded me of one of those, in that sometimes an advisor is dealing with a client, maybe a young client, who just gets spooked and says, I don't want anything in the stock market. And you can imagine that the advisor then has to teach the client that you might think that you're taking less risk by having us manage an all bond portfolio for you. But in reality, you're now taking greater risk of running out of money, because your money's not going to be expected to grow as much over the long run. You'll live through multiple bear markets in your lifetime if you're young, hopefully. But the long-term cost of inflation on your expenses, your inability for your resources to support your costs in 30, 40, 50, 60 years for a young person is substantial. And so we have tools that help advisors illustrate those kinds of things. And while that might not be the most common interaction, giving the advisors tools for sort of all occasions is something that they seem to really appreciate. So anyway, just something that I remember.
No, that's interesting. I was remembering back in college in the 90s in my finance classes, we analyzed Ross Perot, who sold his company for a couple $1 billion. I think he pocketed like $1.5 billion or something like that. He put it all into bonds. And over 20 years, it grew to about $2 billion. But compared to the stock market, it would have grown to like 5 or 6 or even $8 billion.
Sure.
So yeah, I mean, he's not going to outlive $2 billion. Nobody is. But I think the point is you're right. Okay. I have a curiosity question. It's just because you're talking about all this risk. Do you use Monte Carlo simulation? Is that still in use by advisors? And what's your perspective on that?
We use a variation. So we use a simulation. We don't technically use a Monte Carlo simulation. Technically, for those math nerds like me out there, technically it would have to utilize random numbers to generate the paths, and we do not use random numbers. There are reasons for it, maybe deeper than what we'll go through on this podcast. But essentially, what we want to encounter is a lot of different paths like you would have in a Monte Carlo simulation, but some of the areas where we've been able to actually go deeper by not being constrained by the assumption that volatility will be constant is one of the advantages of our mathematical process. Not being constrained by the assumption that the correlation between equities, fixed income, inflation, that's constant is one of the benefits of the way we've constructed this simulation. We also have variable paths for inflation. So we're enabling advisors to incorporate the sequence of real return risk, which goes beyond what's commonly called the sequence of return risk, sequence of nominal return risk. And what we find is someone's financial longevity, right? The how long their money ends up lasting them, is better indicated by the path of real returns they end up experiencing, which of course we don't know in advance, than the path of nominal returns. So in other words, it's not just how your portfolio ends up performing throughout your lifetime. It's that relative to the pace at which you draw from your portfolio, which is indicated by the inflationary path you end up experiencing. And so that's one of the areas where we've gone deeper, and we find that many advisors appreciate that they don't have to give quite so many caveats, quite so many assumptions when they hand over results to a client. I've heard some advisors lament having to say, "Hey, here's the output, assuming a constant risk level, assuming a constant inflation assumption, assuming a constant lifespan," or things like that. They like the fact that Tolerisk varies these things. That last one is very innovative and very unique to Tolerisk. We don't presume a constant lifespan. We don't presume that Jane and John Doe both get hit by a bus on a specific date. We actually build mortality probabilities year by year by spouse inside the simulation. So it's one of the most innovative features, I think, sitting under the hood. And I know we have advisors that seem to really appreciate that. That doesn't mean they want to get into the nitty-gritty math with their clients, but they like being able to tell the client that we're not limited. We didn't assume you both died on someone's 90th birthday. We recognize that there's uncertainty here, and we can account for it. And that helps engender confidence by their clients, which again is all about not only helping their client make better decisions, but have the confidence to stick with the decisions, to know that we ran well more than 1,000 different paths, that we incorporated paths that reflect the depression of the 30s in terms of the stock market, that reflect the inflationary environments of the 70s and 80s, that all of that has been contemplated. And so when the advisor says, here's the right risk level, and by the way, we validated your premise, your assumptions, and you have a 8% or a 14% chance of running out of money, whatever the results are, that the client, their client, our client's client, if you will, can be confident in the decisions. And that helps them stick with the plan and stick with their advisor.
I'm glad you pulled up the hood a little bit so we could hear some of this stuff, because you must have had a lot of fun building this product.
It was. And by the way, there's a seminal piece out there. It was published in Advisor Perspectives maybe 4 years ago, called The Third Generation of Financial Planning. So if anybody's interested in going a little deeper, if you just Google Third Generation of Financial Planning or something like that, you'll find it. But that's a great piece that will give you a little more insight of some of the intricacies and things like that.
So Mark, we're already going long on this episode, and I want to keep going. I just want real quickly to hear your perspective on artificial intelligence, because you're sitting in between this world of behavior and psychology, et cetera, with a tool set that helps people communicate. So I'm just kind of curious how you see artificial intelligence impacting customer experience and maybe your product.
So first, I need to get some kind of artificial intelligence that knows if I'm still in the room, even if I'm not moving, so my light doesn't go off like that. No, it's a great question. I'll tell you candidly, up until a few months ago, I think I was the old curmudgeon here that was dragging his feet on AI. We've been using it in the development process. It's super helpful for our developers. They can code things faster using artificial intelligence. So we've been using it internally for a while, but in terms of the product, I think I was still anchored in some of the older types of AI from decades ago, which was very quantitative. I used neural networks, genetic algorithms as a back in my college and in my 20s, which is a long time ago, probably evident by my white beard here. So artificial intelligence has evolved in and of itself over the years and is evolving very quickly. And something triggered for me, I think, as I gained more exposure to LLMs, large language models, such as ChatGPT, for example. And I've done kind of a 180 on the topic. I have all of a sudden been able to see, thanks to our board and thanks to our CTO and others who've kind of taught me a little bit about how we can utilize this. And so we've been working on some things to improve our customer and their customers' experience. We haven't rolled it out yet, but I'll share with you the first thing that we are likely to roll out is an AI-driven narrative based on the risk assessment. And so we understand that a lot of this is about arming the advisor to better communicate these topics around risk with their client. They're really the 4 topics around risk, right? What are you willing to accept? What are you able to take now and in the future? What's your risk of running out of money? And what's the actual risk of your portfolio to see if it's aligned? So we arm advisors for all of that. But how do you take that, which has a lot of numbers to it? And how do you distill that to something that's narrative, something that, again, makes it easier to explain? We have a wide range of advisors. Some of them are brilliant at being able to articulate these things. And again, we give them visuals to help them substantiate that and deliver that message. But how do we give them something in verbiage to provide this narrative, especially if they want to leave it behind with the client? We have these really snazzy reports that advisors not only keep for their compliance department, because a lot of what they do with Tolerisk is to reduce compliance risk also, but they also deliver that report to their client as a wonderful kind of leave behind. So to be able to give them with a written narrative, leave them with that written narrative in a human voice that embodies them, as well as the unique information of the client at the time of this risk assessment, we think is going to be another big advantageous tool for them. And I'll tell you, we had a ton of fun doing this internally. With things like ChatGPT, you can also give a tone to the messaging. And so we played around with this internally. This is not going to make the final cut, by the way, I'll tell you. But we said, what if we let it use a snarky tone? And let me tell you, if you want to take financial planning type data, risk assessment data, and create a narrative with a snarky tone, it's pretty entertaining if you're a math nerd like me.
That's awesome.
Again, not going to make the live version, but we've had a lot of fun with it, and it's coming. And there's a lot of other things that we see coming to enhance that advisor-client experience utilizing AI. So great question. And for our advisors out there, stay tuned. It's
well, maybe you can have different flavors, like the New Yorker version, the Californian version, the Texan version.
It won't be labeled like that, but in some sense it will be. It'll be different tones based on different styles.
Yeah. Mark, before I ask my last question, what is the best way for people to find and connect with you?
We're pretty easy to find, tolerisk.com, just like risk tolerance, tolerisk.com. You can find lots of information there. For your users, your listeners, I should say, if somebody wants to reach me directly, they can reach out to me on LinkedIn as well. You won't have trouble finding me there. And I'm happy to meet with anybody. If somebody wants to see a demonstration live, if I can schedule myself personally, I'm happy to do that. You can even email me, Mark with a K at tolerisk.com. I'm lucky enough to be the first Mark. We do have more than one Mark, but I got the good email address, so you'll find me there. Thank you.
Like a founder should.
Yes.
Awesome. So here's the last question. Who has had the biggest impact on your leadership style and how you approach your role?
That's a long list, Rich.
We'll have to keep it short. We're almost out of time.
I have been very fortunate to work for some wonderful leaders who've given me a lot. But I'll tell you, the one that pops in my mind first is not someone I worked for. Somebody I met a couple of years ago that I hired actually to design our sales process and hire and train salespeople. And I didn't have that background. And so while a lot of the intended parts of that process were around landing meetings and things like that, I ended up going through his sales training almost inadvertently. And that's because I was his subject matter expert. And I learned so much by going through sales training. It was humbling because I, as a math nerd, I'll tell you, I saw sales as kind of a foo-foo science, and that wasn't fair. And this is what I learned. This was the humbling process, is that sales can be much more scientific than I ever thought possible. And he corrected some real fundamental flaws in how I was attempting to sell software. And so I'll give a big shout out to Monty Patterson, who actually started a company recently called Outbound Labs. So if you're looking for somebody to help with your sales process, Monty is a wonderful resource. So shout out to Monty. Thanks for the
Oh, that's awesome. Yeah, you know what? I'm similar. I'm a product guy. I'm an engineer. I'm a finance guy. Sales is something that's been hard earned for me to figure out. So I completely appreciate that. All right, I got to wrap this up. I want to give a big thank you to Mark Friedenthal, founder and CEO of Tolerisk, for being on this episode of The Customer Wins. Go check out Mark's website at tolerisk.com. And don't forget to check out Quick at quickforms.com, where we make processing forms easy. I hope you enjoyed this discussion. We'll click the like button, share this with someone, and subscribe to our channels for future episodes of The Customer Wins. Mark, thank you so much for joining me today.
Rich, thanks for having me. This was a lot of fun. Appreciate it.
Thanks for listening to the Customer Wins podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.